People always wonder what it truly felt like in those final moments before everything fell apart, before the financial world of the 1920s shattered overnight. They ask if anyone saw the disaster coming, if the warning signs were flashing bright red, if someone, somewhere, tried to sound the alarm but was drowned out by the euphoria of easy money. The truth about October 1929, the moment Wall Street collapsed, is far stranger than most people realize. The stock market crash didn't appear out of nowhere. It was a slow-motion train wreck, one that had been quietly telegraphed for years, whispered about by a handful of skeptical economists, cautious investors, and seasoned bankers, and then completely ignored by millions of Americans whose life savings were about to disappear. In the 1920s, the United States was unlike any nation in history. Its economy seemed unstoppable. The stock market, powered by optimism and cheap credit, appeared to move in only one direction: up. Always up. When an entire society starts believing that prices will never fall, that prosperity is endless, and that doubt itself is foolish, that's when cracks begin forming beneath the surface. This is the story of how a nation, drunk on wealth, speculation, and blind confidence, gambled everything on the illusion that the future had changed forever. The Roaring Twenties were America's intoxication, a decade of booming industries, rapid innovation, and reckless finance. After World War I, Europe lay in ruins, but the United States stood tall, its factories humming, its banks overflowing with capital. Real wealth was being created. Manufacturing expanded, productivity soared, and wages rose. Money flowed freely, and the mood was euphoric. People who had endured wartime misery were ready to celebrate. Jazz music filled the speakeasies, women wore shorter dresses, and automobiles rolled off Detroit's assembly lines faster than ever. Henry Ford's mastery of mass production revolutionized industry. Cars became affordable to ordinary workers. For the first time, Americans believed they could have it all: a home, a car, a radio, even a washing machine. The American dream became about consumption and upward mobility. Real progress was happening, but beneath that prosperity, something darker was growing. An unsustainable bubble built on speculation, margin loans, and blind faith in the stock market. By the mid-1920s, investing had turned into a national obsession. Speculation had overtaken productivity. People stopped thinking like investors and started gambling like high rollers at a casino. The real economy, factories, farms, and industry, was solid, but the speculative economy was ballooning out of control. In 1920, about 3 million Americans owned stocks. By 1929, over 10 million did, many of them ordinary clerks, barbers, farmers, and shop owners. But most weren't using their own money. They were buying stocks on margin, borrowing 90% of the purchase price from brokers or banks. It was simple, seductive, and deadly. You could put down $1,000 and buy $10,000 worth of stock. If prices rose, you made a fortune. If they fell, you owed the bank everything. This margin trading scheme turned the market into a ticking time bomb. People thought they were investors, but they were really debtors, borrowed money on endless growth. Everyone, from small-town workers to Wall Street elites, was chasing fast wealth, not realizing the financial system was becoming dangerously leveraged. Every new investor's dollar pushed prices higher, which convinced others to buy. That surge in prices validated the illusion of safety, a self-reinforcing feedback loop. The Dow Jones Industrial Average soared, and every uptick whispered the same lie. This time, it's different. By 1929, the Wall Street bubble had reached fever pitch. Stock prices had more than tripled. Dividend yields fell below the interest you could earn from a simple savings account, yet people still piled in. Why keep cash in the bank earning 4% when the stock market promised endless wealth? Economists warned that valuations were detached from reality. Prominent financiers urged caution, but their voices were drowned out by the sound of champagne corks and the ringing of cash registers. The Federal Reserve itself was conflicted. Raise interest rates and risk slowing the economy, or keep them low and fuel the mania? They chose the latter. Money was cheap, credit flowed freely, and speculation fed on that abundance like fire feeding on oxygen. By the summer of 1929, even those profiting began to feel uneasy. Margin debt had reached staggering levels. Ordinary Americans had leveraged their futures for a piece of the boom. Banks were overextended, financial institutions deeply intertwined with the market. The entire U.S. financial system had become dependent on prices staying high. And then came September. Yale economist Irving Fisher, one of the most respected minds in economics, made a now infamous statement. Open quote, "Stock prices have reached what looks like a permanently high plateau." Close quote. 2 days later, the market fell sharply. Panic rippled through Wall Street, but it quickly recovered. Investors took it as proof of the market's strength, a mere healthy correction. Confidence soared again. That moment, the false recovery, was the true beginning of the end. Every financial collapse has this calm before the storm, when early tremors are mistaken for stability. Investors believe the worst is over, but it isn't. It never is. As autumn deepened, the real economy began to falter. Car sales dropped, factories slowed production, and unemployment quietly crept upward. But on Wall Street, the ticker tape still flashed optimism. The market had become its own fantasy world, detached from the fundamentals of business and reality. Two economies now existed, one real, one imagined, and both were on a collision course. By October 1929, the cracks widened. Monday the 21st saw a sharp 3% drop. Brokers dismissed it as noise. The next day, more selling. Wednesday, even worse. Then came Thursday, October 24th, Black Thursday. Chaos. Panic. Millions of shares dumped into a market with no buyers. Phone lines jammed. The ticker machines, the lifeblood of Wall Street, couldn't keep up. Prices lagged hours behind reality. People were selling blind, not knowing how much they were losing. Nearly 13 million shares traded hands that day, triple the normal volume. The system groaned under the weight of its own greed. Margin calls flooded in, forcing investors to sell even more. Each sale drove prices lower, triggering more calls, creating a deadly spiral. Banks tried to stabilize the market by pooling resources, but confidence had already cracked, and when confidence dies, no amount of money can revive it. That weekend, newspapers tried to calm the public. Headlines promised recovery, but behind closed doors, fear was spreading through the financial sector, from small-town banks to the halls of the Federal Reserve. Everyone knew Monday would be worse, much worse. Monday, October 28, 1929, the day the illusion died. Over 9 million shares were traded as Wall Street descended into chaos. Prices didn't just fall, they collapsed. The Dow Jones plunged nearly 13% in a single day. Investors who had watched their portfolios grow for years saw them wiped out in hours. Wealth evaporated. Banks faced insolvency. Ordinary Americans who thought they had secured a future through the stock market now owed debts they could never repay. A man who bought $10,000 worth of stock with $1,000 down didn't just lose his savings, he now owed $9,000 to his broker. It was financial annihilation. Ticker machines ran late into the night, desperately printing data that was already obsolete. Prices on paper bore no resemblance to reality. Fortunes vanished, and so did faith in the financial system. Brokerage firms collapsed, their capital erased by cascading defaults. Banks began failing, their assets worthless, their loans unpaid. The interconnection between markets and banking had turned the stock crash into an economic heart attack. This wasn't just a Wall Street problem anymore. It was a national financial crisis, spreading across every layer of the economy. The Federal Reserve could no longer contain the panic. Businesses couldn't borrow, factories couldn't pay workers, and unemployment began to surge. Families lost homes, workers lost jobs. Bank customers lined up outside in the cold, desperate to withdraw their money, only to find that the bank's doors were locked. The Great Depression had begun. Fear replaced optimism. Cash became king. The same credit that once fueled growth now vanished, strangling businesses and killing demand. People stopped spending, hoarded money, and deepened the collapse. The 1929 crash wasn't just an economic failure, it was a psychological one. The entire financial system had been built on confidence, and once that confidence cracked, the structure disintegrated. The tragedy wasn't that no one saw it coming. Economists, analysts, and even some Federal Reserve officials warned about speculative excess, but they were ignored. The incentives were too powerful. The brokers, bankers, and investors all had reasons to keep the game going. Every financial bubble follows this same pattern. From the dot-com crash to the 2008 financial crisis, to the speculative waves we see even today in cryptocurrency and housing markets. Someone always sees the danger, but the sound of money being made is louder than any warning. By 1930, the US banking system was unraveling. Thousands of banks failed. Unemployment climbed toward 25%. The once booming American economy became a landscape of shuttered factories and breadlines. The lessons were brutal but clear. A financial system fueled by speculation and debt cannot sustain itself forever. When the stock market becomes detached from the real economy, from productivity, wages, and goods, collapse is inevitable. It took over a decade for the economy to recover, and only the industrial mobilization of World War II finally pulled America out of the Great Depression. But by then, the damage had already been done. Generations carried the scars, lost homes, broken families, vanished dreams. Yet history keeps repeating. Every boom carries the same illusion that this time is different, that credit is infinite, that debt can't hurt, that central banks can control it all. But reality always collects its debt. The people who survived 1929 weren't the ones chasing speculation. They were the ones holding real assets, real businesses, and real discipline. They understood the difference between paper wealth and tangible value. The tragedy is that every new generation forgets. The same optimism returns. The same easy money policies, low interest rates, and risky speculation reappear, each time with a new name, a new story, and a new justification. The 1929 crash wasn't random. It was a mirror, one reflecting human greed, hope, and denial. It was the moment America learned that markets don't rise forever, and that even the mightiest financial systems can crumble overnight when built on illusion. If this story reshaped the way you think about money, investing, and financial stability, make sure to subscribe, because these patterns are repeating again, and the next chapter might already be forming.